Most people are misreading XRP and Stellar right now because the real story may not be about crypto adoption at all. It may be about the modernization of global financial infrastructure happening behind the scenes. While investors focus on price, institutions appear to be focusing on settlement, liquidity, compliance, and interoperability. In the next few minutes, we'll examine the documented connections between DTCC, Ripple, Stellar, global payment governance, and CBDC research, and separate what is proven from what remains speculation. See, for years, the crypto conversation has been dominated by market cycles, price predictions, and regulatory headlines. But some of the largest financial institutions in the world have been working on a completely different problem. How do you move value across borders as easily as information moves across the internet? That question sits at the center of what became known as the Internet of Value. And it's the reason many researchers continue investigating the roles of XRP, Stellar, and major financial infrastructure organizations like DTCC. Because when you look beneath the surface, an interesting pattern begins to emerge. On one side, you have Stellar developing institutional compliance features directly into its protocol. On the other, you have Ripple building governance frameworks and payment networks designed for global financial participants. And in the background, you have central banks, regulators, and financial institutions all exploring the future of digital settlement. The key question isn't whether digital finance is coming. The key question is who is helping build it. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. One of the most important claims discussed in recent interviews involves Stellar's relationship with the DTCC. The DTCC, short for the Depository Trust and Clearing Corporation, is one of the most important financial infrastructure organizations in the world. Every day, it processes enormous volumes of security transactions. Its role is settlement, risk management, clearing, market stability. And in other words, exactly the kind of institution that understands how global financial systems actually function. According to statements from Stellar CEO Danielle Dixon, collaboration between Stellar and DTCC affiliated digital asset initiatives dates back years. The focus wasn't speculation. The focus was compliance, institutional readiness, operational requirements, and that distinction matters, ladies and gentlemen, because institutions don't ask whether a blockchain is exciting. They ask whether it can operate within regulatory frameworks. They ask whether it can manage risk. They ask whether it can meet compliance obligations. Features such as clawback functionalities, freeze capabilities, privacy controls, governance mechanisms. These are not retail-focused features. These are institutional features. And according to Dixon, these capabilities became embedded directly into Stellar's architecture. Let that sink in, ladies and gentlemen. Not as optional add-ons, not through external smart contracts, but at the protocol level. That is a significant distinction because it suggests Stellar was designed with institutional requirements in mind from an early stage. But here's where it gets interesting. The network remained public and open. A combination people assume could never work. An open blockchain with institutional-grade compliance. Let that sink in. Yet that appears to have been exactly the direction Stellar pursued. History has seen this pattern before. In the 1860s, the completion of the first transcontinental railroad in the United States fundamentally changed commerce. Before the railroad, moving goods across the country was slow, expensive, and fragmented. After the railroad, isolated regional markets became connected into a larger economic network. The railroad itself wasn't the final product. It was the infrastructure. Let that sink in. The value came from everything built on top of it. Financial systems often evolve the same way. The biggest opportunity isn't always the application. Sometimes it's the network that enables all applications. Some analysts believe blockchain infrastructure may eventually play a similar role in digital finance. Not because every blockchain succeeds, but because modern financial systems increasingly require interoperability. And interoperability requires infrastructure. Short-term noise, long-term structure. That distinction investors continue watching. See, while Stellar was developing on one side of the equation, Ripple was building another. One of the most frequently discussed institutional connections involves Donahue previously served as president and CEO of DTCC. In 2015, he joined Ripple as an advisor. At the time, blockchain remained largely experimental within mainstream finance. Yet Ripple was attracting individuals with extensive experience in financial infrastructure. Why? Because Ripple's mission wasn't simply creating a digital asset. The company was attempting to modernize cross-border payments, settlement, liquidity, messaging, governance, areas where institutional expertise mattered enormously. Then another important development occurred. In 2016, major global banks formed what became known as the Global Payments Steering Group. Its purpose was straightforward: establish standards, create governance frameworks, develop operational rules, coordinate blockchain-based payment networks. The significance wasn't merely technology, it was organizational. Because financial systems don't operate on software alone. They operate on trust, rules, standards, agreements. This is where many crypto discussions become overly simplified. Technology solves only part of the challenge. Governance solves the rest. One of the most controversial ideas discussed by commentators involves the relationship between Ripple and Stellar. The theory suggests that separation between the two ecosystems wasn't merely competitive. Instead, it represented strategic market segmentation. To be clear, there is no publicity, proven evidence that a coordinated master plan existed. However, supporters point to interesting differences. Ripple increasingly focused on institutional liquidity, cross-border settlement, payment providers, enterprise solutions. Meanwhile, Stellar emphasized financial inclusion, peer-to-peer transfers, small businesses, remittances, tokenized assets, different audiences, different priorities, different markets, but potentially complementary outcomes. Could both systems serve different layers of a future financial ecosystem? Some analysts believe so. Others remain skeptical. The important distinction is separating evidence from interpretation. And that principle becomes even more important as we move into CBDCs, unified ledgers, and global payment infrastructure. Because this is where the discussion becomes significant, more complex. If infrastructure is on one side of the equation, standards on the other side, ladies and gentlemen. Because it doesn't matter how advanced a payment system becomes if it cannot communicate with the rest of the financial world. This is where ISO 20022 enters the picture. For decades, financial institutions have relied on a patchwork of messaging standards, different formats, different systems, different requirements. The result? Friction, inefficiency, higher costs. ISO 20022 was created to address that problem. Its purpose is simple: create a common language for financial messaging, a standardized framework that allows institutions across the globe to exchange richer, more consistent data. Write that down, let that sink in. Now, this is what most people miss. Transition to ISO 20022 is not a crypto story. It's a global financial modernization story. Most people miss this. Banks are adopting, payment providers are adopting it, market infrastructures are adopting it. Entire financial ecosystems are migrating towards it. Because standardized data creates interoperability, and interoperability creates efficiency. Supporters of XRP and Stellar frequently point out that both organizations have participated in conversations surrounding ISO 20022 related initiatives. Whether that ultimately translates into dominant market positioning remains uncertain, but it does demonstrate something very important. The conversation is no longer about whether digital asset infrastructure can interact with traditional finance. The conversation is about how and who will be involved. To understand what standards matter, we need to look back to 1973. That year, financial institutions came together to create what became the Society for Worldwide Interbank Financial Telecommunication, better known as SWIFT. Before SWIFT, international banking communication was fragmented and inefficient. Different institutions relied on inconsistent messaging processes. Errors were common. Settlement was slower. Coordination was difficult. SWIFT changed that, not because it moved money, no, because it standardized communication. That distinction is critical, ladies and gentlemen. SWIFT became powerful because it created a common framework, a common language, a common operating system for global financial messaging. Today, many observers see a parallel emerging digital finance, not necessarily with one specific company, not necessarily with one blockchain, but with the broader effort to create interoperable standards for tokenized assets, digital currencies, and cross-border settlement. The lesson from history is clear. Technologies matter, but standards often matter more, because standards determine who can participate and how systems connect. This brings us to one of the most discussed themes in the XRP community, the idea of a global rulebook. At first glance, the concept sounds dramatic, but in reality, every major financial network operates according to rules. Rules governing participation, rules governing compliance, rules governing settlement, rules governing dispute resolution, rules governing operational responsibilities. Ripple's net governance model was designed around exactly these principles. Participants needed clear expectations, clear standards, clear procedures. That's not unusual. In fact, it's necessary. Financial institutions cannot operate efficiently without governance frameworks. What makes the topic interesting is how these frameworks could evolve as digital assets become integrated into existing financial systems. Could future payment networks require global operating standards? Almost certainly. Could multiple networks share common frameworks? Possible. Could blockchain-based systems become part of that evolution? Many institutions are actively exploring that question. But here's where caution is important. A governance framework does not automatically prove that a specific blockchain will become the global standard. Those are two separate claims. One is documented reality, the other remains speculation. Think about the Roman Empire. Rome didn't maintain influence solely through military power. It maintained influence through infrastructure. Roads connected distant regions. Trade routes connected markets. Information traveled more efficiently. Commerce expanded. The roads themselves weren't the economy. They enabled the economy. Some analysts compare modern payment networks to those ancient transportation networks systems. The value may not lie exclusively in the asset moving across the network. The value may lie in the network's ability to connect participants efficiently. Whether XRP, Stellar, CBDCs, stablecoins, tokenized deposits, or entirely new technologies ultimately dominate remains unknown. But the race to build the roads of digital finance is very real, and institutions around the world appear determined to participate. Now, we arrive at perhaps the most controversial part of the discussion. CBDCs, central bank digital currencies. Around the world, central banks have been researching digital versions of sovereign currencies. Some are conducting pilot programs. Some are testing settlement systems. Some are exploring wholesale applications. Others remain in early research phases. This growing activity has sparked intense debate within the crypto community. Supporters of XRP often argue that concepts such as shared ledgers, unified ledgers, regulated liability networks, regulated settlement networks could ultimately align with XRP Ledger architecture. The argument typically centers on the ledger's speed, interoperability, and institutional design features. However, it is important to separate documented facts from broader conclusions. What is documented? Central banks are exploring digital currency infrastructure. Financial institutions are exploring tokenization. Settlement modernization is accelerating. What remains unproven? That the public XRP ledger will become the universal foundation for all CBDCs globally. That claim has not been established. Some institutions have explored technologies connected to Ripple. Others have explored entirely different architectures. Others are building proprietary solutions. The reality is much more nuanced than merry narratives suggest. But here's where it gets interesting and spicy. Regardless of which platforms ultimately succeed, the direction of travel appears clear. Financial infrastructure is becoming increasingly digital, increasingly programmable, increasingly interconnected, and that trend extends far beyond any single blockchain project. See, as we move deeper, ladies and gentlemen, into the digital asset revolution, another concept continues appearing in institutional research papers: regulated liability networks, or RLNS. The idea is straightforward: create a shared network where regulated financial institutions can transact using tokenized forms of money and assets while remaining compliant with existing laws and regulations. In many ways, this represents the bridge between traditional finance and digital finance. Not a replacement, a bridge. Banks want efficiency. Regulators want oversight. Businesses want speed. Consumers want convenience. Future financial infrastructure must satisfy all four. That is why tokenization has become such a major focus. Stocks, bonds, treasuries, real estate, money market funds, bank deposits, virtually every financial asset is now being evaluated for tokenized potential. That's so huge, ladies and gentlemen. And this is where projects like Ripple and Stellar attract institutional attention. Not necessarily because of cryptocurrency speculation, but because they offer frameworks that may help facilitate the movement of tokenized value. The long-term opportunity isn't simply digital money. It's digital ownership, digital settlement, digital transfer of value at scale. To understand why tokenization matters, consider the shipping container. Before standardized containers became common, global trade was incredibly efficient. Goods had to be unloaded, sorted, repackaged, transferred repeatedly. Every transfer introduced cost, time, risk. Then came containerization, a simple standard, but one that transformed global commerce. Suddenly, goods could move seamlessly between ships, trucks, trains, and ports. The container wasn't the product. It was the standard. Many analysts view tokenization through a similar lens. The token itself may not be the most important innovation. The inability for value to move seamlessly across different systems may be the real breakthrough. Just as containerization unlocked global trade, interoperable digital assets could potentially unlock new forms of global finance. And the possibility is why institutions continue investing billions into research and development. Now, this is what most people miss. The market often focuses on headlines, price spikes, social media debates, daily volatility, but institutions focus on something else entirely. Infrastructure, standards, governance, adoption, integration. These developments unfold slowly, sometimes over years, sometimes over decades. The creation of global financial infrastructure is rarely a straight line. It's gradual, complex, and often invisible until it reaches critical mass. This is why one of the most important distinctions investors can make is understanding the difference between temporary signals and structural signals. Temporary signals create headlines. Structural signals create long-term change. A price movement may last days. A new financial standard may last decades. Short-term noise, long-term structure. That's why I tell you always pay attention to what's quiet, ladies and gentlemen. That's where many of the most important developments are occurring today. So where does all of this leave us, you're asking? The evidence suggests that both Ripple and Stellar have attracted significant institutional interest over the years. We know senior financial infrastructure figures became involved. We know governance frameworks were developed. We know compliance and interoperability have been central priorities. We know institutions are exploring tokenization. We know central banks are researching digital currencies. And we know financial infrastructure is undergoing one of the most significant modernization efforts in decades. What remains uncertain is exactly which platforms will emerge as long-term winners. Will XRP play a major role? Possibly. Will Stellar play a major role? Possibly. Will entirely different systems emerge alongside them? Also possible. Because financial history rarely follows a single path. But one thing appears increasingly clear. The conversation is no longer about whether finance will become more digital. The transition is already underway. The real question is who will provide the infrastructure, who will define the standards, and who will connect the world's financial systems together. Because while price is reacting, systems evolving, and that evolution may ultimately become one of the defining financial stories of the 21st century. If you've enjoyed this deep dive, make sure to subscribe, hit the like button, let me know in the comments. Do you believe XRP and Stellar position themselves to become foundational layers of the future financial system? Or do you think the market's still underestimating entirely different players? Thank you for watching. I'll see you in the next one. Well, happy 4th of July, everybody. Hope everyone's enjoying cookouts, barbecues, everything. Happy Independence Day, everybody. So I'm going to want to go over here. But first, I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. One solid tip in the pitch, ladies and gentlemen, can play for your entire year subscription. So if you want to understand the deeper macro research and the themes that we touch about and learn how to take advantage of all this, learn how to trade, learn how to invest, come and join over 600 active traders and investors inside the Crypto Public Desk Monthly. Ladies and gentlemen, markets rarely change direction because of a single headline. They change when positioning, policy, liquidity, earnings, and supply chains begin shifting together. Those transitions often create both risk and opportunity long before the broader market recognizes them. See, understanding how currencies, commodities, energy, and technology interact provides a more complete picture of the global economy and can help investors interpret market moves with greater context rather than reacting to individual headlines. Why I say that we're financial mercenaries is because we're going to take advantage of the chaos. Why we're the remora. We feast on the sushi that the apex predator consumes. So long after the talk about the Clary Act getting passed, long after all of these things that people are paying attention to today are gone, all that is left, which has always been left, is the market chaos. The market chaos and disruptions that creates itemized, potentially lucrative opportunities for accumulation and trading. None of this is financial advice, ladies and gentlemen. This is just my own opinion, and anyone retains myself or our organization. But right now, copper fell almost 4% over the last week, and the whole hard asset complex went red with it. Okay? This is when I have been making an argument to everyone that retains us, family offices, sovereigns, that's so important. See, because everyone uses algos, they do what everyone else does. It's crazy. Everyone's paying attention to the new reality of which is finance. The dollar right now is the crusher of all speculative assets. As it moves higher, it snuffs out everything else, okay? Well, let me ask you something. When the systematic overlay of that narrative is over, and this trade is over, and deficits are overblown, you got to ask yourself something right now. Where do you look for opportunities? Part of being a financial mercenary is you have to win on the battlefield every day. So stay with me right now, right? We're going to talk about constant copper. I know it's boring, right? But if it makes sense, it makes dollars. And if it makes dollars, it makes my bank account and trading accounts go green. And that's all that matters. So we don't get caught up like sushi. Because Goldman Sachs on June 3rd, Goldman's cut its global copper mine supply forecast by 350,000 tons in one report, which is the annualized output of a mid-sized mine taken off the model in a single afternoon. That's so crazy and massive, ladies and gentlemen. Stay with me right here, okay? They then revised the deficit outside the United States from 60,000 tons to 640,000 tons. A 10x change in the gap between what the world produces and what the world needs. Write this down. This is massive. See, the reasons Goldman gives are specific and physical. See, in Gasberg in Indonesia, Freeport's mine, a mud rush in September killed 5 workers and threw Freeport's production plan out of alignment. Again, you don't read that in headlines because it's not important to most people. I don't watch soccer games, football games, hockey games. I watch news so that we can prosper from it. See, it's not expected to be back on at attended volumes until 2028. That's so massive right there. Forget about it. Copper's in play, baby. In play. And Kamuakala in the Democratic Republic of Congo, hit by systematic seismic activity that flooded the underground workings. They just cut its own 2026 guidance to 290 from 330,000 tons and pushed the ramp of stopping into the first half of 2027. That's rough. Bank of America came to a similar place independently. They're projecting copper prices at $11,300 per ton in 2026 and $13,500 in 2027, with a peak scenario as high as $15,000 if disruptions can compound to LME pricing. Okay, Morgan Stanley, not to be outdone, penciled in around 4.83 CMM price dollars per pound for 2026, well above the year-to-date average, grounded in the same list of mine problems. So we got 3 institutional forecasts, 3 different desks, one direction, and the demand math to understand is moving. Ladies and gentlemen, you want to come and learn and see the 2 biggest copper plays. Come and join the Crypto Public Desk monthly, ladies and gentlemen, because I'm not giving that away for free. But these 2 plays are going to turn out very, very well over this demand situation right here. Because guess what? Guess what? It's not financial advice. As mercenaries, we find leverage. When you find leverage as a financial mercenary, you find a disruption. Once you find a disruption, you take advantage of the disruption in the equities play, the futures play, every play you can. These numbers are so massive, it's crazy. You're not going to see the AI situation slow down whatsoever. You got a situation where the U.S. is going to be going against China, printing money, building to pull their economies out of this. They created a situation that we got to win this situation or the world's going to come tumbling down. Do you know what I think? Again, I talk about history a lot. You need a reason to manufacture. You need a reason to consume. You need a reason. There's the reason. Soviet Union was bankrupted. I don't think the AI situation plays out like that, but it's not going away. They're not going to stop building data centers. China is not going to stop building data centers. They're going to consume resources. There's not enough copper. These numbers tell a story. Look, to us, it's very personal being in the mining and refining industry. Right then and there, being financial mercenaries, you take advantage of all of this. So, ladies and gentlemen, if you want to learn how to trade, you want to learn how to invest, doesn't matter where you are, you want to learn how to take advantage of situations. Because long after narratives are gone, there will be daily disruptive situations that we take advantage of forever. Come and join the Crypto Public Desk Monthly and come and join over 600 active traders and investors learning the trade craft that I was taught on the New York Mercantile Exchange. So if you want to learn to trade, invest, come and join us. The link is in the description of the video and in the pinned comment, ladies and gentlemen. Because guess what? Being the remora, we just gobble things up. Identifying opportunities like this. This is so massive. It's like when this call is as big as when we gave the call about nickel. Again, most people, they're not paying attention. This is massive. So I hope on this July 4th day, everybody's enjoying the barbecues, the pools, the beach. Everybody, please pay attention to your children. It only takes 10 seconds to look away and someone can drown, unfortunately. So please pay attention to your kids at the beach, at the pool parties. Please pay attention. Please pay suntan lotion on. You don't want that melanoma. But pay attention to what's quiet, ladies and gentlemen. Because on days when no one's paying attention, these are the most profitable days. Have a happy 4th of July. I love you all. I'll see you on the front lines. This content for educational information purposes only. This is not financial advice. Always do your own research and consult a licensed financial advisor. Never, ever invest anything based on watching a YouTube video. Always do your own research. I love you all, ladies and gentlemen. I'll see you on the front lines. Happy 4th of July, baby. Happy 4th of July.